Thanks for sticking with us. As you heard, I'm Jason Zweig from the Wall Street Journal, and we're here with Susan Byrne, who's the founder and vice chairman of Westwood in Dallas, which manages about $18 billion. And we're going to cover a pretty wide range of topics here, I think. Susan has a really interesting perspective as a 45-year veteran in the money management business. She started when she was 7.
Yes, preschool.
Sorry about my error. I wanted to kick our discussion off in a way that maybe is a little different from what we normally do at investing conferences. I wanted to read a passage from a book to Susan, and then I'll ask her to comment on it. So it's a little long, and by the time I'm done, you may find it a little peculiar, but I think you'll enjoy hearing it, and you'll love her explanation, I think. So here it goes. At the first squad meeting each season, held 2 weeks before our first actual practice, I personally demonstrated how I wanted players to put on their socks each and every time. Carefully roll the socks down over the toes, ball of the foot, arch, and around the heel. Then pull the sock up snug so there will be no wrinkles of any kind. I would then have the players carefully check with their fingers for any folds or creases in the sock, starting at the toes and sliding the hand along the side of and under the foot, smoothing the sock out as the fingers passed over it. I paid special attention to the heel because that is where wrinkles are most likely. I would watch as the player smoothed the sock under and along the back of the heel. I wanted it done conscientiously, not quickly or casually. I wanted absolutely no folds, wrinkles, or creases of any kind on the sock. Then we would proceed to the other foot and do the same. I would demonstrate for the players and then have the players demonstrate for me. Susan, what is this? And why was it important to you? And why, when I read it, did it make me sit up and take notice?
This is a story from Coach Wooden. When he was asked the way in which he would prepare his athletes.
Sorry, Susan, I have to interrupt you right now. Not everybody in the room knows who Coach Wooden was.
Oh, yes, I forget. This is the part of starting in preschool. Coach Wooden was the legendary basketball coach of UCLA. And in that basketball team, they won 10 NC2A championships. And it's relevant to me because, well, at that time I was young and poor, which I spent most of my youth. And, but my husband at the time was going to school. So we had a student card, and what we could afford was to go to the basketball games at UCLA. And I became quite a devoted fan of Coach Wooden, who was an outstanding man. He's written a number of books. And he was describing in there the way in which he cared for his athletes to prepare for a game. And the first thing he wanted them to do was to prepare, and the first preparation was how to put your socks on correctly. And people thought that was extremely weird. However, he won because his entire concept of preparation, how you prepared, was very, very important to winning. So that's...
Right, and so for people who might not be familiar with the history of UCLA basketball, what's the connection between Coach Wooden and your firm's name?
Well, when I was starting the firm, this is way back in '83, I'm sure a number of you weren't even the gleam in the eye at that time. I started the firm on precipitously on April Fool's Day, April 1st, on 1983, And the idea at that time would be most people who were starting money management firms were naming them after themselves. And I had really never thought of that. I mean, but I thought, well, okay, so my name, even though it's spelled B-Y-R-N-E, is pronounced Byrne. So when I was saying it, it sounded like Byrne Capital. And I think even all of you know from prestigious Columbia value orientation that that wasn't going to work. So I went back and looked for a name that had some connection to me. I admired Coach Wooden's values and his teaching, and Westwood, the name wasn't taken, and most importantly, it sounded sort of substantial. It didn't sound like a woman in her late 30s and a telephone and a wastepaper basket. So at any rate, that's how we got our name. And it's been a great name, and we're very proud as Coach Wooden has passed on now, but his philosophy on how one builds success in life and as a team has been very prominent in our work skills.
So what's the analog in investment management to learning how to put your socks on right?
I guess a number of the people who are here learning how to put your socks on right would know that it all has to do with the little things, the smallest things, and not being afraid, as someone said this morning, not being afraid to say, I don't get that, or that doesn't make sense, or why that number, why does that work? So I think the preparation, the best thing that Wooden did he has a pyramid of success, which is a pyramid with all of these blocks with different values in them. But all of the ones on the bottom of the pyramid, the ones that hold up the rest of the pyramid, are basic values like preparation, perseverance, ethics, values that we know to be, that will go on in life, and they lead with, if you have individuals holding up the pyramid with those value structures, then working as a team to achieve a top rung is just a byproduct. It just comes out naturally. The hard work is doing the little things precisely right in the proper order.
So thanks, Susan. So we know that Westwood is facing a lot of the same headwinds in the asset management business as many firms are now with the rise of passive indexing and smart beta and factors that we'll hear about later from Andrew Ang, I think. How are you responding as a business to what's going on in the industry and to the outflows that your firm is also seeing?
We've experienced outflows and fee contractions as technology has come in and brought the cost down on producing, let's say, an average return. The question is that because of compounding, as you all know, a long series of average is a winner. So when you're working for folks who are saving for something out in the future, their retirement or college or whatever, the need to pay a lot in fees really isn't there if you can produce average consistently. So we have looked at that. Our industry was ripe for disruption. In a classic sense, we had excess rents. Our margins were high. And the technology has brought the cost curve down to attack those margins, as you would expect. So our response to it, after I sort of, gnashing of teeth and tears, and this isn't fair, and all of that sort of management struggle, we have been, for the last 2 years, investing a great deal of our money into technology and deciding what are the core competencies of that we have as humans, and what are the competencies that we can use by using technology. And so I would say that we're almost ready to roll out some new ways in which our customers can control their own. We will incorporate some robo-technology in what we do for our, so we've segmented our clients. We have institutions, and we have high net worth individuals, and we have younger players who use our mutual funds or would want to be enrolled, let's say, for money that's in the hundreds of thousands. Let's say somebody might start with $100,000, which is a lot of money, I know, for a lot of you students to have in cash. But so we have tried to segment our business and so that we can keep and serve all the different segments of it. We've also tried, as I said before, looking at what it is that we can do well. And I think what we do well is how I sometimes explain the difference between the function of a portfolio manager and the function of an analyst. I had been an analyst briefly, thank heavens, and became a portfolio manager. But the role of a portfolio manager, and I think of a money manager going forward, is to concentrate on whether or not you know how to ask the right question. Getting an answer is fast and easy and cheap. Asking whether that was the right question to ask, was that the relevant question? Is that answer at all relevant to what you're doing? How important is that answer? All of that soft side, judgment side, is what I think we as humans can do, and we will use technology to create ways to express our points of view.
So let's go a little deeper on that last point, Susan. I mean,
I hope I have something deeper.
You do. So one of the little catchphrases I use a lot when I talk with individual investors is that, you know, in the world we're going into, you know, humans should do what humans are good at, but they should accept that machines should do what machines are good at or better at than people. So talk for a minute about what you think humans will remain able to do better than machines or algorithms or software, and what software and algorithms are going to be or already are better at than people.
Well, I think, you know, this sort of solve for X is much better done by computers,
right,
and faster.
In domains like...
In a linear world where you have to solve for X, then they will be faster. But the variables that you put into that, let's see sales growth at 6%. What the human says, put it at 6%, hold the margins at this level, hold debt at this. What comes out is an answer, and you have to know whether that answer is important. But I think that what's valuable is for people to learn. I think through experience, you begin, hopefully, to know what's possible. I mean, could, you know, a lot of it, let's say a small growth company that they're give a speech and, you know, they're hiring 5,000 people a week. I mean, I send to that, I'm like, you're not hiring 5,000 people unless you're opening a prison yard or something. I mean, there aren't 5,000 people in 1 week you could possibly screen for. So you get to learn that. You get to learn it because you run your own company. I'm also a small, you know, small company, and so the decisions are really important. But I think one of the things that's important for all of you who are still students is to find out, just as Jason said, find out what you're actually really good at. And let that be what you contribute to the team. that sounds really, really simple. I've found it to be one of the more difficult things in managing and hiring professionals, is that there's a sense that maybe that person may perceive themselves to be good at everything, because maybe they've always had really great grades. So there's the thought that they know everything. Some of that is just generational tension, as you have, but some of it is to enter into something with the humility that says, I have a lot to learn. And we have tests that we have at our company, and where you don't, you're not really being tested in the sense of sitting down and taking a test, but you're running an algorithm over the various decisions you've made. And what we're looking for is an area of expertise. Were you very good at weighting your individual stocks? And when you get all of these data and you perform that kind of analysis, you will find that there are people who, you know, I mean, that they won't give a grade for it. I mean, there are some people that have a sense of timing. They just do, and you can prove it through the data. And there are people that have no sense of timing at all. They can get the absolute earnings per share number perfectly correct and have no earthly clue as to what to do with that answer. So in there is where you can make a contribution. In technology, you always have to keep in mind, if you're using AI or algorithms, all of these things are based on things that have happened before you ask the question. The data mining. If this, then what? These are all based on what things did in the past. And we, as professionals, are not asked to analyze the past. We're not history professors. We're asked to make a judgment on what might be possible in the future. And if it happens, is it important? Is it good enough for me to risk the loss of money? And oftentimes it's not. These are very different. I know that Jason has done work on behavioral finance, and this is more into that. And so I think maybe people think, well, this is sort of a soft science. You bet it is. You bet it is. And you really would do well to incorporate it along with the kind of more linear thinking that one would be taught in terms of how to do spreadsheets and how to find what the data is. So anyway,
so you mentioned a minute ago about the importance of finding out what you're good at.
Yes.
So when did you figure out what you were good at? And did that come sort of in an epiphany as the result of a particular event or outcome, or was it gradual over time?
It was a dark and stormy night. No, it came to me fairly quickly. I didn't perceive it to be that I was particularly talented at it. But it turned out that when I started my career, well, first of all, I started my career as a secretary in 1970. So there wasn't a lot of call for my judgment. In fact,
a secretary in the investment management business?
Secretary. I worked at E.F. Hutton in Battery Park as a secretary, one of 4 or 5, to the Bob Foman, who was the chairman of E.F. Hutton at that time. And I was sort of an appointment. So there wasn't a lot of call. I had opinions, but there were not very many people who were interested in them at that time. So I worked my way up to become an analyst and all of that. But when I went to the what we used to term the buy side, and I went to work at Bankers Trust as an assistant portfolio manager, there was something about the way I could analyze and take in a lot of information, and pretty quickly see what was the most important piece. In other words, not get stuck in the weeds of, you know, just so much stuff you get overwhelmed. So I was able to make decisions and judgments that weren't, you know, they weren't always right, of course, but I could be decisive. And I think for me, frankly, that part was just a gift. Other parts of it, the discipline of working hard, the discipline of studying at night, every night, all of these things counted, of course, but the ability to cut through a lot of stuff to get to the thing is a gift I've always had.
So what was it like being one of the few women in the industry back then in the Stone Age, as opposed to the Enlightened Age we live today?
Yes, well, because I never have been a man, I wouldn't know the difference. So I would never.
You don't know what you're missing.
I would never know the difference of what it would be like not to have been a woman. But I must say, a lot of my mentors, because there weren't women ahead of me, were men. So, I mean, when I think back on it, very, very patient. One job I had that really helped a lot was that I was, I was a research editor. So I'd have to come in, you know, I thought I was just brilliant. I'd placed out in English and not, you know. So they told me, so I went in and I would take these research reports and I'd go through them and try and make them be readable. And so in working with them, a number of the people I worked with would explain to me what they were trying to say, and then I would put it into English. And I learned a great deal from them. I'm just embarrassed to think about what a pain in the neck I must have been to these very patient and gracious men. Mm-hmm. It was, in some ways at the time, there wasn't a lot of thought about women being in finance. Mm-hmm.
But were obstacles thrown in your way, or was it just that you were unusual in being a woman at all?
I think I was unusual, and there were obstacles, meaning like, but we don't, you know. I can tell you one, I'll tell you one. There's a very large money manager somewhere in the Midwest, and I was working at GIF Corporation, and I was the treasurer of the company. And I was in charge of the outside money managers. And so I went to visit this one money manager, so this would be...
They were running the pension fund?
They were running a portion of the pension fund. They were one of the managers. And I went to visit them, an on-site, normal deal. And they took me around to tell me to introduce them and said, you know, and here are our guys, you know, and they've all gone to Princeton and Columbia and, you know, Harvard, and they're really great. And here are their assistants. We hire women to be their assistants. And I went, and they're from Smith, and they're from, and I said, well, they said, well, we don't have women for money managers. And I thought, am I invisible? Does he not know he's saying that he doesn't hire women and I'm his customer? So at any rate, that was kind of the way it was. It wasn't mean. He didn't mean anything by it. It just simply was the way it was. So I hated being poor, so I just kept pushing and pushing and pushing.
So because I'm nearsighted, I'm going to ask for a show of hands. How many women portfolio managers in the audience? Put your hands up nice and high. Jenny is not the only one. How many aspiring women portfolio managers in the audience? Hands up. So Susan and I are the only people in the room who can see how few hands went up. I mean, I don't think we got 10.
But I think we did.
What's the industry going to do about that?
I don't know. I think as we move, as our industry moves, and we increasingly incorporate technology, that, I mean, some of the biggest boo-boos that people have made in their life were made in their, by, let's say, insulting a certain segment of their client, or some consumer, were made because the people in the room were all the same kind of people, And so you know these stories where, people had to take, they'd be sending out a big new product release, and it would be insulting because the people who were making that judgment weren't in there. So I think that from my perspective, the idea of a different perspective and an empowered perspective, not just one person in the room and 12 other people that don't even talk to them. I'm talking about diversity, which allows for other viewpoints. And I think that makes for a richer discussion, a richer product. I just think it's a very practical thing to do. I don't have a whole philosophy on it. I just, at Westwood, we have, we call it the Rainbow Coalition, but I mean, we have people from all over the world and all over people because we value their insight. So when we're making our judgments, as I said, if you're looking to see how probable it would be that your assumption on sales growth or margin growth or payout ratio, how probable is that if they're in a certain country or with a certain segment of society? If you don't have the person that knows the norms of that place, you might as well be shooting dice.
Mm-hmm. So what do you look for when you're hiring? If somebody's an alum of this program at Columbia, what should they bring to an interview with Westwood that might get them the job?
I really like people who are not afraid to think differently.
And how do you pick up?
Because
on
I'll
that?
ask them questions about what they've done and what they've read, and I like people who are very curious, and that would indicate that they're curious about things beyond. This is where I think women sell themselves short. I give talks at women's universities or co-ed universities, and there's a lot of self-deselection by women. They'll whether that's an internalized, I'm going to go into marketing, I'm not going to go into finance, because everybody's so grade conscious. If I get in there and I'm just with boys, they'll get the good grades because they're good at math, and I won't. And they're like, I don't want to go in marketing. That's where the women go, and they're good at dealing with people. These kinds of things. So I don't know. I don't think the universities are putting them there, but I think it's there. So I also like to see people who have a wider range, that they've read read books, that they've thought about other places. Having grown up rather modestly, I didn't get to do all of the things that I would have liked to have done, and traveled when I was young, and but I did have books. I had a library card. I was interested in how other people, why did they do this and not that? And it helped me a lot as I'm trying to determine what is reasonable to expect out of a group of people who have this set viewpoint. And I look for that curiosity in people. And I also look for people who like to work on a team. The portfolio manager, is sort of this reminds you of a picture of the guy, at the helm in the sailboat, all by himself, moving off, That would be the image of a lot of, and there are people who work alone, and that is the best way that they work, and they're brilliant, and God bless them. We're looking for people who like other people and get thrilled with the idea of taking on a challenge and working together to meet the goal. And that there's a lot of excitement about that, and there's a lot of sense of worth by being able to do that.
So we'd be crazy if we didn't talk about value investing for a few minutes. You know, traditional active fundamental value analysis is kind of under assault from the world of ETFs and index funds. How do you think a long only or a long mostly fundamental, active, value-oriented business is going to look in the future?
Well, I think a lot of it is going to use ETFs and maybe some passive. I would prefer ETFs, and we use ETFs as tactical vehicles. So it may be that we're making a portfolio shift. I like the ETF better than having to use futures because I hate debt. I'm just a total adverse to debt. So I like using ETFs, you know, for part of the portfolios because I can overweight a sector, underweight it, and because I think it's maladjusted, and I can get that return and get out. So there's that. But I think that but from a value viewpoint, I think it's time that people start really thinking. I guess was it 1980 that Milton Friedman, thank God I'm not at the University of Chicago. Any rate, when Milton Friedman said there is nothing else, there is no role for a public company other than to maximize shareholder profit. And I think we're at a point in time where we really have to, for me, maybe because I am female, maybe I think differently than men, and you know, isn't that great?
Right.
So, at any rate, I think with issues politically that are happening, we have this ESG movement. Have any of you heard of ESG? Okay, all right. So it stands for environmental, social, and governance. And it's a motion that is starting where companies that are public will be graded on their ability to meet these specific criterion. So including, and the part about S, social, has to do with what the company as policy, you know, do all of your employees get paid a living wage? They're going to be graded from A to F. I mean, I think Milton Friedman, that noise was just him going, oh, he's turning over in his grave. But, and where are you in the issues of environment? And what about sustainability of your products? And governance, we're pretty into it. I mean, I certainly know it by being a publicly held company because we've had Sarbanes-Oxley, et cetera. So most public companies are pretty good on governance, and if they're not, it's well known, and it counts against them. If you're a company that's considered not to have good governance, the shareholder value is impacted. So I think we will take that in, and that's real soft stuff. I mean, you know, if you think, non-linear, so that's coming in from Europe, but it's being pressed on here. And I think that's a real trend that's coming. And value.
So Susan, let me interrupt you for a second.
Yes, please.
So while I don't always hear it expressed with so much conviction, I hear something similar from almost every active manager I meet with. I think there's a sense in which, you know, ESG, or socially responsible investing, as some people call it, is kind of being seized on by active managers as almost a lifeline or a life preserver. And it's sort of, well, ETFs can't really do that because they're just machines and we're people, so we can not only make judgments about value, but we can make value judgments the same way our clients would like us to, so we can present ourselves to clients and say, we're making human subjective judgments about qualitative factors that determine whether companies are responsible or sustainable. But the thing I always come back to these folks with is I don't see why that can't be done algorithmically too, and a lot cheaper.
I'm sure it can. I would agree with you. And I do think that, because we're talking about what is value in a broad sense, not necessarily active management or passive management. Because I think within maybe 5 years, you will have the kinds of rankings in these areas that are done now by ISS or people that rank on governance. And that's an input which can be put into a computer and handled. You can do a portfolio by SIC code.
So then what's to keep you know, the Vanguards and BlackRocks and similar firms of the world from putting active value investors who are using ESG out of business the same way they would if you weren't using ESG?
Yeah, well, that's a very good question. There will always be people for whom getting something that's the cheapest would be the best. Where we have put our money in everything from converting our entire business and products to digital, which we're actually, for a little bitty company, we're ahead of a lot of people in that. When we move to digital, which is where people say, you know, I want to be where the puck is. So the puck we think is over here. And we want to be there at the same time that BlackRock and Fidelity and Vanguard get there. Because there will always be a market for people who want to talk to a human. They'll want to say, you know, what should I do? So all of the money we're spending is geared toward that. And we've just acquired a bank. We've set up organizational structure for people for planning. So we're hopefully, and you know, when you run a company, you don't know that you're going to be right. Just because I think the puck's going to be there and I'm going to get there before anybody else doesn't mean I'm right.
Yeah. All right. So let's take our last couple minutes before we open it up to questions. Are there a couple of names in your portfolios that exemplify either traditional value or are attractive on an ESG basis, or maybe both, that you'd care to talk about very briefly?
Well, I think the classic ESG, which will be questioned now, would be a company like Johnson & Johnson. When we say Johnson & Johnson or Procter & Gamble and names like this, people, or Coca-Cola or names like that, those are companies that have invested an awful lot in their brand. In the portfolios that we hold right now, a name that wouldn't be thought of as a typical value stock might be something like PayPal or, and not eBay, but PayPal. And how would a value manager get into a name like a PayPal? We have 2 or 3 of those names. And it has to do with an orientation where you don't, if you go through all of your work looking at a company and you put in your estimates and your margins and you come out and you think they're going to earn $5 a share, and then you go, it takes a lot of discipline because you want to look at what the answer is first, but you can't. So you have to say, okay, I came up with $5. Then you go and look and see what the consensus is looking for. So we like to find companies where we might come up with a company we think they could easily earn $5, and the consensus is $3. So we value that company based with some kind of a haircut based on earning $5 is to see whether it still represents value if it earned $5. And then we apply a valuation on that and discount it back. So we can get into companies that would, to some people, appear to be growth stocks and overvalued. We do not buy growth stocks if our analysis bottom up comes up with anywhere near the number that the consensus is expecting, because we would consider that stock to be perfectly well valued and we don't have any edge. So we'll use that.
Yeah, great. Thank you, Susan. Let's throw it open to questions. You know where the mics are, and please step up, and we'll be happy to take your question.
Oh, come on.
No, we have one over here.
Oh, good.
Good morning. Thank you both for being here today. I was stunned when I looked back and saw there were just so few hands being raised when you asked the question. Here's a stark statistic, and if this statistic is wrong, set me straight. Apparently, in 2019, women-owned investment firms represent 3% of all investment firms in this country. And of those 3%, those firms control only 1% of investable capital. True or false? Or not sure?
I don't know, but it sounds plausible to me, and to me it kind of sounds like a sort of a value opportunity. What do you think, Susan?
Yeah, I don't, that may be true, and it may be what I spoke about before, this idea of self-selecting, that women in business school that would tend to go more to the marketing side instead of the finance side because they wanted to have a higher GPA, didn't want to compete. But what I've found is that everything I've been describing going forward with the use of technology, these are areas that women excel in. That, you know, I mean, and what's needed is the idea that women in many cases are very different from men. That the idea that one has to think like a man, have the same skill set as a man, to have value is where we get in trouble. In many cases, I don't have any of the skill sets some of the men I work with. And our company has 60% of our employees are women. And we've managed to do fine. We work well in teams, but I don't, a lot of what we're talking about by the use of technology says that what's really important is the product and the client that's absorbing it. And women take care of people, and they take care of their customer. And if you want to, the lady from Estee Lauder, she was amazing and really great. So I would hope that women would realize that we don't, and men, that we need each other, that we have different skill sets, and that if we can work together, we can do a better job for our customer.
All right.
Jason, could you write about this, please?
Yes, I think maybe I should. Do we have a question over here?
Yes, I'm wondering if you could talk a little about the decision to be a publicly traded company.
Yes. We became a publicly traded company in 2002 by a financial backer. I started the firm in 1983 in New York City. And then in 91 or so, 1990, moved to Dallas. Our family moved, and kids, and so there I was, commuting between Dallas and, it was pre-fax, let alone internet. And the people that backed me in Dallas and took out my partners in New York and everything, reorganized it, they were a public company. And so in 2002, they wanted to gain, the firm had done very well and it was very undervalued from a book value. So they took the company and spun it out. I mean, we bought it again, and they spun it out as a dividend to shareholders. Because usually, if you get far enough in money management to break even, then everything else is gravy and you don't need capital.
Yeah. Susan, let me jump in for a second. And maybe, if I can, maybe I'll refocus the question. Jack Bogle, who died a few weeks ago, talked a lot about the potential difficulty in running both an investment management organization and a public company, and he often used this term, it's like serving two masters. because obviously the CEO has a fiduciary obligation to the public shareholders, but the investment managers have a fiduciary obligation to the clients, and those can come into conflict. How have you managed that?
Well, I managed it by stepping back as the CEO. Probably not, that was probably a fairly unusual thing to do. Also, when we went public, I had worked with a fellow named Brian Casey, who is still our CEO. And within 2 years, he was made the CEO. And I stepped back to become the chief investment officer because of that. In addition, we never had hedge funds because we felt we couldn't serve two masters. How would we, who would get, you know, we just didn't want any temptation, I guess. We never thought we were good enough people to resist temptation every time. So we just didn't have it. So that's how we did it.
Yeah, okay. So I think we need to cut it off here. But Susan, thank you so much for your time.
Thank you, Jason.
This was a lot of fun, and thanks to all of you.
Thanks.